Well, that's a long discussion because we do find the growth very attractive. The buoyant economies always give a headwind to economic growth. But let's start from where I come from. I'm the director of a pension fund, and we have fiduciary duty. So when everybody talks in this meeting about mobilizing capital, we have capital that we want to invest, but subject to our fiduciary rules, which require safety, profitability, convertibility, and liquidity. Those are watchwords given to our fund by the United Nations General Assembly. By the way, I'm the United Nations Joint Staff Pension Fund. So we invest in basically any country, although from day to day, we may have exposure to maybe only 25 or 30% of the countries of the world. And fortunately, we have a very good exposure to Africa. Following our rules of safety, we have always to look at the rule of law, and we love to see domestic savings and investment before we go in large quantity into any given market. And these are criteria that are improving in Africa. We are actually very encouraged to see the new startups of sovereign wealth funds because they show that there's local money in these markets. And I don't know about you, but I want to eat when the chef eats his own cooking. So having the local investors doing well is always very encouraging. Last year, when we had our investments committee meeting in Botswana, we looked to the model of the Sovereign Wealth Fund in Botswana. There is good governance in Africa, and I think it's a growing trend. That's why we want to commit more money. It's not just the growth, because as I think others on this panel have pointed out, growth does not always translate into profitability for investors. And our goal is to earn a profit because, as a pension fund, we have liabilities to pay pension benefits to any employee of the UN where they may retire. So that means I have a liability to pay pension benefits in many countries of the world, including the 48 in Africa. So I want it to be perfectly matched, which of course is never possible, to have investments generating cash flow in each of the markets that can generate a safe and profitable return. As for the business environment, we are seeing tremendous improvements. We would love to see more currency stability, more assurance of the rule of law, of avoidance of capital controls, and looking at the liquidity building in the markets. And I think the interest in African growth is going to build on liquidity in every way. Our fund started investing in Africa almost 40 years ago, simply because of our constituency, which of course includes member states from every nation in the world. And that gave us some much better insight going into the less liquid asset classes where we began our investments in 2010. As of the present, our private equity portfolio in Africa looks very different than our private holdings in the rest of the world. And the reason is that we found that in the high growth markets of Africa, the opportunities were actually better in private equity than public equity. And we have seen some exits from some of the early deals that we did that are actually helping to grow the public markets too. But I think that Sarah's point about encouraging venture capital in earlier stage is an important one because it's those entrepreneurs that get the business community growing so that a very conservative investor, such as a pension fund, or probably like our colleagues in the sovereign wealth area, need somebody to get the ball rolling. And it's those entrepreneurs that are really going to energize Africa. So as far as we're concerned, we see tremendous growth opportunities. We like the private equity markets better than the public equity markets now. We have exposure to fixed income. We have exposure to real estate. We have exposure to public markets. We have a pretty balanced portfolio in Africa. But compared to the developed world, we're much more oriented towards a private equity because of the way the growth translates into returns for our fund.
Just to, an add-on question, you're mentioning that you tend to prefer the private equity space in terms of investment rather than the publicly listed investments route, because you think that the growth opportunities are higher in the private equity space than in the publicly listed space. But when I look at the statistics regarding the performances of African exchanges over a period of 10 years, I mean, the performances have been very, very attractive in US dollar terms, spanning, on average, on many markets, higher than 18 to 20% in US dollar terms. So why are you shunning that space, and why are you rather concentrating on the private equity space, which I think is as important, but for a pension fund that is, looking at investment opportunities where exits are important, being in the private equity space, of course, means that your exits could be five years down the road, whereas being in the publicly listed space means that you can invest, and then if there is growth, you can reap the benefits of that growth. So what's your take on that?
I think the way to look at this is a history of any pension fund, that the assets are built up over time. And quite fortunately, my predecessors in the UN Joint Staff Pension Fund had the wisdom to invest in the public markets of Africa before I came. And as pioneers in those markets, they contributed nicely and continue to contribute to the performance of our fund. So what I'm saying is that today the incremental money is more going into the private sector, and that's partly because we already have such a healthy exposure to public equities in Africa. And I'm very grateful for my predecessors for making those wise investments. We have recently diversified and added additional public equity too. But where the most commitments have been made in the last couple of years has been in the private equity space. And we've found that to be very attractive, and we look to increase our commitment in Africa. Again, we are global. We allocate our assets where we see the potential for returns. And I keep hearing people talking about political risk and corruption, but just listening to the local newspaper here, you realize that political risk is not just in Africa. I mean, there's political risk right here where we are. So let's see where political risk really is. We've looked at infrastructure investments all over the developed world, and some of those stories are not very pretty. And I guess I shouldn't name names because it would be politically incorrect, but look at some of the more public infrastructure deals all over the world, and they do share some risky characteristics. And again, these are not unique to Africa. As a public investor, I'm always asked, why don't you help us build this road or this hospital? And those are wonderful things to do. But again, the local community has to want to pay part of the stake. If the local community does not want to contribute to an investment, how is it that I, as an investor, will get a return or a need to raise prices or a need for additional capital or additional support? If a project isn't popular enough to get some local funding, then I have to be more careful. So again, I look at the development of better entrepreneurial spirits in Africa, and I see that as a great positive. And I look to the future for the building of additional sovereign wealth funds, because it's that local capital that gives me the comfort as an international investor. I want the chef to eat his own cooking.
Doing business in Africa, you can't afford to be without Africa Investor.